Okay. G'day, Omar. Thanks for making the time tonight.
My pleasure, Tom. Good to catch up with you, as
It's
always.
been ages. Like I remember you came to a meetup that we had, I think around about 2016, and there would have been only 400 people on Savvy at the moment. At the time, it's
2016, 2018, I can't remember. Yeah,
it was a
I reckon.
long time ago.
I was actually looking up the presentation. I could tell.
It was a while ago. It was the first time I'd come across the 18.6 year property cycle.
Yep. And you've read the book since then, and
I've read the book. Yeah, you were the person that introduced me to that model.
there it is, the
Um,
secret life of real estate
you've got it
investing.
handy. For the people that don't know Examine Property, do you want to tell them a little bit about the business and your role in that business?
Yeah, no problem. So it's a bit hard to pigeonhole us. The issue with like real estate services, you've got sort of so many people out there, different definitions, do different things. But our business is mainly about, working with clients. Most of them refer to us from financial planners and accountants. That's just the way we traditionally sort of marketed the business and source clients. It's not exclusively that, but that's been the key area where we attract our clients from. And basically, it's about advising property investors that want to invest in the market. Not so much of whether they should or shouldn't be doing it. We leave that to the financial professionals, accountants, financial planners. But basically about once they've got a budget, what they want to achieve, give us a bit of a sort of background. It's about where to go, where would I buy now? And obviously it's investors looking to make money, not people that we don't get involved with, people that want to buy a house to live in.
Homeowners. Yeah.
Yeah, we do a little bit of buyers advocacy in that space, but generally I like to keep out of it. It's too emotional, and the drivers are not normally what we teach people and what we look for, and it's not our bread and butter typically. So it's about where would you go if you want to make the most money over the next 5 years, 10 years, 20 years? Where would you go? Which city? Which state? Which regional town? Obviously, just in Australia, we don't do international.
Mhm.
And which suburbs? What should I buy? Should I buy a unit? Should I buy a townhouse? Should I buy a house? Should I buy a farm? What type of particular class within the mainly residential. We do a little bit of commercial, and then it's about finding the property for them. So people can go look themselves if they prefer. They just want some advice, or they want us to analyse their existing portfolio, or they're looking to offload a property in the next 2, 3, 4 years, or maybe I might have 5 properties. I need to sell one. Which one should I sell? Which one is probably not going to grow over the next 5 years? So we do a lot of analysis. So it's not really, and obviously we do buyers advocacy where we go out and look for the property. We also are a vendor's agent in some cases where we'll find sort of property that's built or getting built. So more like a typical sort of real estate agent in that case. But it's pretty broad. So that's why it's be hard to, people call you, some people want to call you a property coach. Some people want to call you real
Yep.
estate or buyer's agent. Like our services are many.
Yeah.
And it's all around the investor. It's basically depends on what you need. Some people just want some advice, or I want to buy something. Where would I go? And I'll say, look, you for your budget, 600,000. I'd go to Perth. I'd try and pick up a house. It's not going to be a large size. These are the
Yep.
type of suburbs where your budget. This is where I'd be buying. These are the reasons why, and they can go off and do it. If they need help, we're happy to go out there and find a particular property. Like the investor has a say in it. Obviously, we're there just to provide the information and give them the logic behind it. And if we've done our job properly, it's pretty easy for them to make informed decisions.
Yep. What I love about the breadth of your service is you actually, the research is national. So you cover all the different markets, which we'll talk about today. One of the questions that we had from two of the people from Savvy, Rosalind and Param, they asked about the 18.6 year property cycle. I noticed that you had some slides. I was wondering if you could walk us through the cycle and tell us where we are in that cycle at the moment.
I'll bring that up. My favourite topic to talk about, obviously. I like to call it talking the big secret. So it's 18 years, the book. So I prefer to use that. But
Yep.
if in terms of timing, it's sort of can be between 16, 17 and sort of 20, 21 years, but averages out, according to Phil Anderson, around 18.6 year is sort of the average of sort of recent history over the last sort of 100 years or so. So I'll talk a little bit about it. So generally what happens, I'll cover off maybe the previous cycle, because people know that. They know the GFC, when it happened, and whatnot. So
Yes.
sort of 93, after the recession that we had to have, if people remember, the last major recession under the Hawke Keating government at the time. And generally what you have is sort of around, look, the numbers aren't always exact, but generally around a 7-year sort of recovery growth in the property market. So I don't want people to think about just Sydney or just Melbourne or the WA or wherever they live in Perth. We're talking sort of macro level, on a global scale. So what we're talking about here is pretty much the US market, and Europe sort of follows it. There's a lag, or a year or two. I was actually looking at some numbers on that today. In Australia, generally we're about 12 months behind. So these are more US macro level data. So you might be, in a city where, in say 2011, like the most recent cycle, that's when sort of Sydney and Melbourne started to show, some green shoots, and Canberra sort of started to come out of the doldrums a little bit and start to grow, whereas Perth was still booming up until sort of 2014. Brisbane, they had the floods. It sort of dropped in 2010. It was still dropping in 2011. Sort of bottomed out in 2012. So every city has its own economic drivers, its own cycle. This is sort of more on a macro level.
Gotcha.
So in terms of 1993, after the recession that we had to have, the market sort of grew for about 7 years, and then around, if people remember, around the sort of 2000s, around the Olympics, there was a little recession around the world. Nothing major, bit like the COVID recession that we had. Always the middle recession isn't a major crash, because property markets aren't involved. Yes, property markets will come off the boil like they did during COVID. We had very minor drops, or just the market sort of cooled. But generally, it's not a credit-led crunch like we saw when the GFC hit. So it's sometimes it comes down, jumps back up, goes back down, which is what we've seen. If you look at sort of Melbourne, for example, the market sort of came down, went up, came down, and now it's starting to sort of recover. And that can last a year, 2 years, sort of 3 years, but generally it's 1 to 2 year in terms of economic slowdown. And then we have sort of a recovery, and then right at the end, which is where we are at the moment, is what we call the winner's curse. So that's there's going to be a lot of euphoria. Stock market's going to go on forever. Property market's going to keep booming, and then we're going to see a crash. I'll just click it there around 26, 27.
Okay.
Again, this is the land market. If you remember, in the US in 2007, we had Lehman Brothers,
GFC,
Fannie Mae, Freddie Mac. They wobbled around 2007. And started to fold. The share market crash didn't come to 2008. So always at the end, if you pay attention to the land, you pay attention to what's happening in the US in the land market and with the banks, that'll give you the signal to jump out of the stock market. So that was sort of 2007 is the land crash. Again, 2026, 2027 is probably going to be the land. We might not see a share market crash till 27, 28. But you can pretty much guarantee it'll play out very accurately. Then obviously, prices come down. This is more evident in the US because of the bigger property market crash over there. Certain places in Australia, like the Gold Coast and that, a bit more volatile. You see like more 30, 40% drops. But then it sort of bottomed out sort of 2010. And then the market starts to sort of make a recovery, and then that puts us back around 2011. Australia, 2012 again, because we lag a year or so behind the US market. So where we're at the middle, we're sort of just past the mid-cycle slowdown, sort of around 2020, Phil Anderson sort of thinks the peak of the market was 2019, even before late 2019. They got a lot of their investors in the stock market. So we're a couple of years into the recovery phase, and we're approaching the winner's curse phase. So, but again, each market is a little bit different. If you ask me where Sydney is, Sydney's at the peak. It's going to drop in the next couple of years, sort of bottom out. It'll mount a recovery, probably around 26, 27, and then when the next sort of financial crisis, property crash sort of strikes internationally, it'll take another dip, and then sort of settle down. And then, if you want to go back to sort of 2012, 13, 14 for Sydney, that'll be around 2032. That's when
2032.
Yeah, that's when the next big, it'll go and double and triple over the next sort of 10 years.
Okay.
That's the period to look for.
So that's the next good re-entry point.
Yeah, for Sydney, I think the next re-entry point will be any time from about 2-3 years' time onwards. So nothing wrong with getting in a little bit early. And what you're going to see is obviously, rents will continue to grow. So even though you might not have massive, sort of capital growth, you will still get capital growth up until 2032, but very moderate. And we'll go through some numbers of a similar period, sort of that. Sort of last cycle from 2004 to 2014 for Sydney, sort of a 10-year period where we had growth, but it was very modest, nothing like we've seen. So prices over the last 10 years, sort of gone up 100% at least. Some areas, closer to 200.
Yeah, it's been crazy.
So yeah, look, it's that. But if you want the secret in Australia in terms of a city level, most places, except for probably Melbourne sort of follows this a little bit closely. So, Melbourne had a growth period, had a bigger slowdown in the middle than sort of Sydney and some other cities did. And it'll start to get going soon. There was a question on that, I think, from someone. What do you see? Will Melbourne's growth ever catch up to the other states? Yes, it will. What time frame? I think over the next sort of 4 or 5 years, it will play some catch up. It will get hit around that 26, 27 slowdown a little bit and sort of recover. So it's not all downhill in terms of, for Melbourne. I like Melbourne. I think it's a great place to invest. I wasn't a big fan of Dan Andrews, as Tim knows and follows my Facebook, Dictator Dan. I think he's done some damage, especially in terms of interstate migration. Melbourne was, once Perth backed off and Queensland after the mining boom, the most interstate migration was going into Melbourne sort of over the last, 8-9 year period, except for the last sort of 3-4, once the lockdowns and the damage to the reputation of Melbourne and the damage to the economic prospects and that came with that from being the most locked down city in the world. So it's taken a bit of the shine off, but I think Tung and I were speaking a little bit about it earlier, that obviously everyone can see, migration's running red hot the last year or so, and it's going to probably continue. And the bulk of that is going into Sydney, Melbourne, Brisbane, and Perth, and very little elsewhere. Those sort of 4 cities are taking the most of that. So Melbourne's population growth, I think, is tracking above the Australian average. I think around 2.6, 2.8. It's actually a bit better than Sydney. So, hopefully that'll start to turn things around. Very positive on the Melbourne market. It is a great city, great place to live. And if everyone remembers, it was growing a lot faster than Sydney. It was actually predicted to overtake Sydney's population.
Did that happen?
Predictions were sort of around by 2030.
Okay. Bit of time left.
I think it's backed off a little bit with the drop in interstate migration, but I think it'll definitely come back. It's a great city. It's not going to be defeated by Dictator Dan, so it'll rise from the ashes like the phoenix. But
the last time that we were at the winner's curse, right about the global financial crisis, property prices dropped like pretty dramatically in the United States, not so much over here. Now that we're at the same winner's curse phase now, what sort of price correction do you see in the market?
Look, I don't think. I think we're going to get saved by the mining sector again.
I think so too.
That's
Yeah.
my prediction. We're going to get lucky. The lucky country is going to
Yep.
get lucky again. And if you, you see a lot of the states that are starting to power. It's traditionally those mining states. So yes,
Yep.
it hasn't obviously happened yet in the Northern Territory, but I think Darwin is very cheap at the moment. I think that's not that I'd invest there. It's a bit of a volatile market. I think you're better off going to Perth. But you've seen Queensland's already been running for the last 4 years.
Yeah.
Perth started to go the last 2, 3, and don't listen to a lot of these experts out there telling you, Perth's at its peak. I think Perth's going to run probably for the next 8 years. So
Yeah.
Most of that's going to come in the next 3 to 5. So you'd want to be getting in now, not waiting too long. So yeah, I think we're going to get saved, Tom, because last time, GFC hit. Like I said,
we didn't have a recession.
No, we didn't. Like
we just plain sailed right through it.
I don't know if we're going to get that lucky, but I don't think we're going to be in a similar position to the US and the Europe and whatnot. I think we'll get saved again by the mining sector, because you think there's a bit of a race on at the moment with the BRICS nations and the Belt and Road Initiative. India's investing like crazy. Picking up the slack. I think so. You're going to see a lot of these developing nations, and I'll put China in that same bucket, even though it's a lot more developed. But I think we're going to see a lot. And you got technological advances. You got electric cars, AI, data centers, massive demand. Like one of the big areas for construction in Australia and obviously around the world has been data centers and that. So the land's always in use. Just the type of use can change. And
you also mentioned that the land peaks before the share market. Is there a particular reason why?
Peaks, or it starts to decline before.
Yeah. So if I look at the chart,
the whole economy is built on land. So land is the true holder of value in a way our economic system. Because you think about it, if you've got economic prosperity, land prices are. We were talking about it before. Land prices are going to go up. If you've got technological advancement, land prices, are going to go up. It captures the gain. So I know it's hard for people to sort of fathom, but the reason why we'll go into it a little bit now, because we're going to look at sort of Japan and that. The reason why we've got such high land prices for a developed country is pretty much because of the economic prosperity. We had a long run up until COVID. We had
30 years without a recession.
From the 93, you're looking sort of nearly 28, 30 years with no recession. So we had a long economic run of prosperity, and all that is filtered back into land prices. So and I don't think it's going to change. We're still popular with immigrants from overseas. They all want to come to Australia for its prospects. Obviously, semi-decent government. Used to be great government, but I think that's dropped off a little bit. But they probably haven't woken up to that yet. But we've still got great prospects compared to other regions in the world. And look, migration is great, especially when you're getting good quality migrants that are coming here, getting educated here, educating their kids, buying houses, working, contributing to the economic prosperity, consuming. Obviously, that drives. That's why they're trying to pump the population, because obviously that pumps economic growth as well. So I think the prospects look pretty good, and we'll go through when we drill down on Japan some of the reasons why. The growth in that working age population is really good for the economy and good for.
It's a great chart. I love that chart.
So, there's going to be, unfortunately, if you're not in the market in property, I don't think it's going to get any easier. Maybe in the short term for Sydney and in Canberra, also take a breather for a while. Hobart, if you're looking at going there, that's pretty much done for the medium term, if not longer. So there are some areas where it'll become more affordable as wages rise and the property market cools down. But a lot of other places like Perth and Queensland and I think Darwin's next, and Adelaide probably keep growing for the next 2-3 years. So that's coming towards the end of its cycle soon, but it's not going to get any easier for people.
Gotcha.
So talking just with this, it's not a new phenomenon. So this is US public land sales in acres. So when they sort of privatized land, previously was owned by the US government. So when they started selling off the land, you can see from the 1800s, not 1818, 18 years. The first two were exactly 18 years. Next one, third one was a bit longer. But you can see, and this is volume of land acre sales. So you can see an established sort of the 18, 19-year cycle. And they've tracked this obviously into the 1900s and into the 2000s. Again, if you want to buy the book, The Secret Life of Real Estate and Banking by Philip J. Anderson, we're not going to go into it too much, but it is a thing and it does repeat. So it's worthwhile looking out for it. This is just a chart that I used to put into the slides. I've sort of found it today, but we're just looking at, we're talking about performance of cities. Obviously we've seen Sydney go crazy, and this is sort of from January 2000 up until sort of December 2010. So a whole 10-year period. And I think last time we did this at the Savvy Investors Forum in the city tool, I think one person get it right. I think they just went against everyone else and got it right. But when I ask people which one's Sydney, generally they'll pick the green line, the purple line.
Oh yeah,
it's actually the blue line at the bottom. So during that decade, the worst performing of the sort of 5 major capitals,
wow,
was Sydney. And if Darwin was there, Darwin would actually be above Perth.
Look at Perth
line there. So Sydney sort of grew from that 93 period, especially in the late 90s. And people talk about the Olympics. So what's going to happen with the Brisbane Olympics? What I say to people, the Olympics are good because it commits the government to the infrastructure. So if you're going to have an Olympics and you're not going to build road infrastructure, transport infrastructure, it's not really going to add to the growth in land values. But what it does is it commits the government, so they can't backtrack out of the infrastructure. So my opinion, I think Brisbane's going to peak around 28, maybe 29. So it'll actually peak before the Brisbane Olympics. I think it'll be in decline around the Olympics. That's my call. So Sydney had the Olympics. It actually slowed down around. I bought my first house in October. I think I settled in October 99. I bought at the peak of the market at the time.
Yep.
And I think I paid 250 grand in Auburn. You know where that is, the house behind my parents. And then, by 2000 around the Olympics, it probably dropped 20, 30 grand. I'm like, oh my God, what have I done?
Yeah.
And then it just sat there. And then sort of late 2001, 2, just went on a rampage and sort of doubled in value, more than doubled in value by the sort of beginning of 2004. And then obviously the bottom fell out of it, and you can see it on the chart here.
Yeah.
It sort of dropped. And then around 2007 started to mount a recovery, and obviously the GFC hit, sort of backed off a little bit. Then sort of around 2009-10, started its recovery into 2011-12, and then obviously since 2012, it sort of performed a bit more like the green line of Perth there. But yeah, it's people just have short-term memories. They only see recently, and the problem, the cycle being around 20 years, by the time you finish your school education, you start working, you might be working through 2, maybe 2.5 cycles if you're not like Tung and don't retire early. Some people might get to 3 the way it's going, but most people never see it, never figure it out, because we always got the what are they called, the come on, Tung, help me.
Television. So is the Is the goal to have enough capital set aside so at the start of the cycle, you've got enough money to get in?
Yeah, so the problem is when, like when COVID hit, and the stock market tanked and whatnot, no one had money. Like no one was, even if they did, they weren't willing to commit. So
March 2020,
a lot of the time
40% drop.
opportunities. Yeah, look, the share market got smashed.
Yeah.
30, 40%, like, great buying opportunity. Even the housing market, like really dipped and, like the numbers don't really show it, but a lot of people picked up some really good bargains, even in the Sydney market, and other markets. When the opportunity comes, very few people have that fund. So
They're afraid.
back up. So I'm just going to go back up to that slide. So the main thing here, people tell me, "Oh, should I be selling everything?" No, you just don't want to load up at the wrong time. So
Yeah.
like I said, if you think now, oh, it's too late for Perth. Perth's not going to follow this exact track
It's different.
of the market. It's not going to top out in 26, 20, 27. Sydney's already topped out. I think sort of Adelaide will probably top out around then. Brisbane will be close to the top of the market, maybe another year or two. So it's not they're going to exactly follow that, but I'd be more wary about loading up at the peak. Like if you bought in Sydney last year or two, you bought at the peak, and rates start rising, people start to struggle. If you're not financially strong, then this for some people it could be disaster. For some others, they'll be able to ride it out. But
I think the key takeaway for me in this slide is if you've got the capital, you've got the patience, just hold off to 2030 and then just look for
Sydney,
bargains.
why not buy in Perth, ride it up, and then come back to Sydney in 2030, 2032?
True.
So there's always an opportunity. That's the good thing about Australia being such a large country, very economically diverse. It was mainly the services sector, financial sector, technologies, medical. A lot of that's centered around sort of Sydney and Melbourne and sort of the eastern seaboard.
That's true.
And it's been no secret, the best performing state economically, over the last sort of 10 years was New South Wales. Second best, probably sort of Melbourne. Some people say Tassie. Canberra did well on the back, obviously, government jobs and expanding the public service. But now it's going to shift to more that sort of mining base. So you just got to follow the economic prosperity, I guess. It's the same with any asset, any investment. You want to buy, where you're going to make money. You don't want to buy where you're going to lose money, or if you went, say you went to Perth, for example, in 2012, 2013, 2014, you bought near the top of the market. You would have just recouped your money over the last year or two, maybe up 10, 20%.
Yep.
In 2014, you came to Sydney. You could have bought a awesome house in Borkham Hills for 700 grand. Now it's worth 2.1 million. Like it's a big difference for buying a $700,000 house in Perth that's maybe worth 850, 900 now. To buying one in Borkham Hills that's worth 2.1 million. Like you're a million, 1.2, 1.3 million ahead. So that's the benefit of timing. And most property people will tell you, oh, timing's not important. It's a long-term hold. Properties are long-term assets. Yeah, but you can actually outperform what you would have done if you timed it right. So it's like anything, you can ride the stock market. March 2020 comes, you can just sit it out. But if you sold out and you went and rebought, at the bottoms, how much more money would you have had now? And you do that again in 26, 27, you sell out, the market or house falls out of the market, then you rebuy back in. You do that a few times over your working life in your super fund or your investments, you're going to be so much better off. You're going to have probably, I'm not going to pull numbers out of my rear, but you're going to be much, much better off than someone that just rode it out, But that's the key. It's just timing. Not telling everyone to go sell, but if you're coming up to retirement and you got a property in Sydney and you got a couple in Perth, I'll be sitting on the ones in Perth, selling the one in Sydney. Like if you need the funds, and that's what I'll be doing, because they're going to probably double if not more.
Outperform.
Next 8 years. The Sydney one probably going to go sideways, maybe grow 20% over the next
Mm.
8, but you're much better off, being in Perth or Darwin or, pockets of
The thing I
Brisbane.
noticed during the last cycle, so we had the GFC in 2007, 2008, and Perth just kept growing because the WA was in the middle of a commodity super cycle,
Exactly,
and
yeah.
that super cycle didn't stop until 2014, and so their property market just kept going, and
Kept
it
going.
didn't tank until 2014.
But then you got like a little bit more diversified. Brisbane had a bit of tourism and stuff. So, that sort of Brisbane topped out in 2009,
Yep,
2010, it dropped, 2011, the floods hit, and
yep.
2012 sort of bottomed out, and started to grow a little bit, 2013, 14, 15, 3 to 6% per annum. And then it sort of died in 16, 17, 18, and then started to make a comeback in 19. And then it's been all the rage the last 4 years. So, each one, that's the good, we've said it before, that's the opportunity with Australia. Like, it's so diversified, each city, has its own sort of cycle and where it is in its own economic prosperity and what's going to happen in its market. There's always an opportunity somewhere. It's just, with property
Yeah.
as a
On that note, do you want to go to the slide?
So you just don't want to,
On that note, do you want to go to
into
the slide with the state-by-state breakdown?
This one
That
is
one.
just, I just want to talk. Someone put this up. I think it was on Savvy, but I found it interesting, so I saved it. But it goes through sort of 10-year periods and shows you sort of the house price growth, and sort of Perth. I know it sort of grew a bit in 13, 11, 12, 13, 14, but then it sort of dropped and went sideways. But 1% growth over that period. Obviously, it's grown a little bit. It's grown a significant amount since then.
Wow, look at Melbourne.
Sydney, 2004 to 14, 24% growth over 10. Is that a good investment to grow 24% over 10 years? It's like I had a client recently. I did a property review for them. They bought a house in when was it? 2000 and trying to remember the dates. I think 2016. They paid about 260 for it, in a really suburb near Mount Druitt, not a great area.
Okay. Yep.
By 2022, it was worth about 750. I did the
Wow.
valuation. I said, "Is that a good investment?" I go, "Look, it's tripled in value in like 6 years." And he goes, "Yeah." And I said, "Look at the guy before you." I go, "He bought it in, I think it was 2002, so a couple of years before the top of the market. Paid 230, kept it for 14 years, sold it for 260. Made 13% in what was that? Yeah, for 13% in 14 years."
Wow.
So I said, "Is that a good investment?" He goes, "No." I go, "It's the same house. Like, you shot the lights out in 6 years."
So you can time the market.
And that one had basically no growth in sort of 14 years. So each market, and I think if someone wants to, I don't normally reveal this, but each market generally has an 8 to 10 year period with no growth, very little growth, and then an 8 to 10 year period where it sort of shoots the lights out. So it's about catching it at the right time. That's pretty much the cycle. I think we've covered a few other things in there as well.
That was good.
Want to talk a little bit about Japan? I think,
Yeah.
because you put this up the other day on Savvy, and I always save them because it triggered something. I actually did this a few years ago, and that's the slides I'm going to go through. But
I loved how cheap Japan is, because I had some friends who came who went to Japan for a holiday, and they were saying that the cost of living is really low, partly because of the currency exchange, but also inflation's been really low. And so, they shared with me that a bowl of udon was like $8 Aussie, whereas you try to get that in Australia, it's like 22.
Yeah.
And so I started looking at property in Japan, and Japanese property relative to incomes was ridiculously cheap.
Yeah,
Still.
compared to like, obviously Tokyo is very expensive, like, in comparison, but there's a lot of other regions where it's very cheap. I think Tokyo, Sydney's probably more expensive, but I think in comparison to the rest of Japan, it's, we should all move there, but they won't let us in.
What did you like about this chart?
Sorry?
What did you like about this chart?
I just, like I said, I've come across it before. So, Australia, Canada, really good immigration. And people always say to me, oh, in Australia, the only reason property is expensive is because of negative gearing and all the tax benefits that investors get. And I think we spoke about it before, Tung, and you found it surprising. But Japan has actually very similar, negative gearing laws to Australia. So very favourable towards investors. But where's their property bubble or property boom or property growth, compared to Australia and Canada?
Mm.
Obviously, Australia gets good immigration. Canada gets, good immigration, better than the US. It's easier to go to Canada than get a green card to the US. This is another chart. This is sort of up to June 2013 from Deutsche Bank, but the blue lines are real house price growth. So this is net of inflation. So before anyone sort of questions the numbers, it's actually net of inflation. The actual growth with inflation is a lot higher. So you can see Australia, for example, around 175% growth, net inflation since 1990, and over 300% since 1975. So if you include that prior sort of 15-year period, huge. You look at Japan, it's actually gone negative, whether you look at it from 1990 or 1975. So net of inflation, it's cheaper to buy property now, even 2020, in Japan than it was in 1975.
I'm surprised by Italy and Germany.
Yeah, a lot of the European countries yes, their property prices aren't like here.
Wow.
Obviously, got New Zealand, Ireland, Australia, Norway, Netherlands, Sweden, Canada, Denmark, UK. So some European, but yeah, it's interesting. I'd like to dig in a bit deeper on this. I should have, but I haven't. But yeah, just in terms of Japan, because they've had, I think we were talking about it before, but they've had sub 2% interest rates since the mid 1990s. Actually went negative as well, and extrapolate that till now. Their rates are still way below 2% in Japan. So you got low interest rates, you got investor incentives. It's like where's their property bill compared to
that's very cheap money.
So Australia, we only saw. Oh, sorry about that. So it's sort of where were we? Sort of 2016, 17 that we sort of went sub 2%. So Japan's had it since the 90s. So the main reason, obviously, population's got something to do with it, which we'll get to. But you can see the dotted black line. That's Japan after World War II had massive economic growth. In the sort of early mid 90s, sort of started to stall, sort of up and down. Whereas Australia sort of, especially since the 2000s with that mining boom, massive jump in economic prosperity. Obviously, that's been on the back of labour force participation in Australia has been rising. It's still up there if you extrapolate it till now. In Japan, it's come from a very high base. Obviously, they had that great economic prosperity where they had sort of up around the 73, 74% labour force participation, but that's really declined with their ageing population and obviously lack of immigration, which we'll go into in the next chart. But it has surprisingly started to recover slightly since sort of 2015. And it's I actually looked at numbers up until now. It's sort of hovering around that sort of 63% mark at the moment. So I'd like to know the reason for that. And the main reason it struggled is because this is the 15 to 64 year old. This is only up to 2014, but it's been extrapolated out up until 2050. So that's the orange. So their working age population's been shrinking since the 90s. So shrinking, not having many kids, very little migration, very tight migration. A lot of obviously the industries are they've got some good good industries. A lot of the manufacturing is done in other countries now, so you need workers to. Well, you previously did, but now you can use
Robots and AI.
That's Well, what's going to happen moving forward? That's going to be interesting, but it's probably for another day. Whereas when you look at Australia, and that's why obviously we can look at the population statistics from the last couple of years. It's off the charts. So our working age population has been growing. You can see a big ramp up during the mining boom there. And it's predicted to stay probably sort of since 2022 probably bashing the lights out of this. So the last couple of years, and you probably will for the next few until they sort of rein it in. But population growth, I think, sort of tracking around at 2.5%. I think we were talking about it before, Tom. Like traditionally, if you look sort of 8-9 years ago and look at the previous sort of 10, 20 years, I think it was sort of around 1.1, 1.2%. So we're tracking around double the population growth.
And that's probably the biggest macro driver of housing prices, which is population.
I need somewhere to live.
Yeah, and when you overlay what the government's done with immigration, it's just turbocharged it.
Yep, and we're not building. The cost of construction's through the roof. So you got land prices have been escalating. Government charges escalating for their DA costs, council contributions, infrastructure levies, construction materials went through the roof. Labour costs are going up with the cost of living, and just the fact that there was a shortage of tradesmen.
And all the bankruptcies.
I don't think it's going to have a major impact unless you get stuck and you're one of the poor people that the builder went broke on. What it is doing, what I see, is that it's increasing construction costs. So a lot of the tier 2 builders and smaller builders are going under. A lot of the banks traditionally have, but now they are insisting more on tier 1 builders. So tier 1 builders, now they can charge what they want. So if you look at sort of 4 years ago, 5 years ago, a lot of them got into trouble because they were undercutting each other, picking up jobs on very low margins. And obviously, the COVID came along, supply chain issues, and that just sunk them. So I think it's starting to settle down. I think you'll still have a few more sort of, and the media likes to beat it up, but you're always going to have builders going broke. Like, I got a friend who owns one of Sydney's biggest house and land building company, like in southwest Sydney, and his dad bought the business in 2008. That was during the GFC, picked it up for nothing, and obviously he's grown the business and it's sort of booming. But that's starting to slow down. There's not a lot of new. They're just doing a lot of previous contracts, stuff like that. So I don't think it's gonna dent the market. I think it'll just probably keep the costs high.
I think the impact it has is that it shrinks supply, because if you don't have builders building new houses, the supply curve shrinks. And if you keep loading up immigration, the demand curve increases. When we put those two of them together, prices go up.
Supply shrinking because I think cost, Tom. That's the problem. So you go to Brisbane, for example. I got an apartment in West End. I had a lot of clients buy in the last few years, but you can, like a good 2-bedder was maybe 600,000. Now they're probably around 850.
Yep.
But you want to buy it off the plan, it's starting at 1.1 million. So like
now 1.1 million for a 2-bedroom.
From 1-bedder. I just picked up a 1-bedder, secondhand 1-bedder for a client for 527,500. So under 530. You want to buy a similar one off the plan, they're 750. So like you're still going to have some people stupid enough to go pay that, but generally it's hard to sell. The secondhand market's rising, and it's rising quickly. Like I could tell you, just in the last 2 months, looking for that client, those apartment, the 530 one were sort of in the 470, 480 2-3 months ago, and it's just rocketing up, and
wow.
So they're catching up, and that's what I'm seeing around Australia is that even in Sydney, like house prices grew significantly. Apartments grew, but nowhere near as much.
Apartments not so much. Yeah.
Yeah, but what you'll see now, and you can actually see it in the numbers, they're starting to close the gap because again, the cost to replace.
Okay.
I had one of my mates, his brother. I just reviewed a unit for him. I think it was in Canterbury, Belmore. I was just looking at the strata report on it today. 2 bedrooms, 700 grand. Like you can hardly, like that's a smaller building, so cost of construction now is probably
Yep.
650. So like it's almost that replacement cost without buying the land, paying the council, paying the interest, paying the marketer to sell it, and making a profit. But about 6-9 months ago, maybe, I had a client that bought something and they couldn't build it. But the tier one builders in Brisbane were quoting 750, 800 a box. So to build those apartments, I'm telling you that 800 is costing that much just to construct it, let alone buy the land.
Wow.
And make a profit and pay your interest. So there's a bit of a mismatch. So I think, and just affordability, like with interest rates at say at 2%, once interest rates go to 6, which they are now, 6.5, if a house in Sydney drops 10-15%, it's not going to make it much more affordable compared to 10-15% more, but at 2% rates. It's making it a lot less affordable. And you're seeing, in Sydney, sort of lagged in Melbourne, with the cladding issues and the quality, and Opal Tower and all these, Mascot, and like the construction quality's been really bad in Sydney. A bit better in Melbourne, but not 100%. So a lot of the faith of Australian people in the unit market sort of has been dented, but now it's starting to recover. I think a lot of people will be sort of more settling for apartments because they just can't afford the house price, especially in Sydney. But we're seeing it, obviously in Brisbane, the house market, the last even since 2012, 13 in Brisbane, a lot of the inner city sort of 10K radius, the housing markets were performing really well. Apartments weren't, but now everything's on the move. So yeah, I think building, I think it's just adding to the cost. All these builders going broke. The cost of insurance, I don't know if you saw, it's gone up. I think about $5,000 extra now for a house in Melbourne. So all that just keeps adding, which again restricts supply because it's getting more and more expensive to build, and less people can afford it or take the risk, or there's not enough margin for builders. They have to wait for the market. But if they wait now in Brisbane, there's hardly any apartments in construction. Hardly anything being sold off the plan. So massive migration, massive demand. So obviously prices are going to come up, which will then make it feasible for them to build, and then obviously they'll start.
We're seeing a lot of that growth now in rental yields. So rental yields have gone up tremendously.
I was actually looking at something on that today, but the yield hasn't really gone up much because the prices have gone up, obviously.
Yep.
But, rents have been cheap for a long time. Like, even in Sydney, obviously property's been on a rampage for 10 years, but rents haven't kept up with the growth in property prices. In Brisbane, they were sort of stagnant for 8-9 years, but no one came along and gave the investors a tap on the back saying, thank you, Mr. Investor, for keeping the rents low for 10 years. But also when interest rates were falling, people didn't, the landlords just think, I've got a good tenant, I'm not going to up the rent, rates are going down, and I think a lot of people were complacent landlords, and the rents were probably artificially too low for a long time. Yeah, but like in comparison to property prices, like the yields aren't, as a percentage, they're not really growing. Yes, the rental numbers going up.
Yep,
so
that's a good point.
rising, but as a yield, not really. They're actually, in Brisbane, they've been declining, so they just haven't been keeping up with property price. I think it's starting to decline. Perth, the last couple of years, they were still there, but they're starting to decline as well. So Adelaide, they've been declining. So yeah, look, I'm not discounting the effect on people. You know, people need to live there if you don't own a house or whatnot. But they've been cheap for a long time. So
They're not
yeah.
cheap anymore.
But that's what you'll see. Like I remember, I think it was 2012. You know, I had a semi in Newtown. I think the one about 900, ended up getting it for like 860, freshly renovated. It was renting for 850 a week, so like a 5.2% return. And all of a sudden, you know, I think I looked at it a few years later. It was like 2 million, and the rent was I think 1100. So
Mm-hmm.
the rent had grown a little bit, but nowhere near the price. Now it's worth well over 3 million. I bet you the rent probably maybe sitting at maybe 1400 or something like that, 1500. So like a 2.6% return compared to 5.2% when it was a sort of the before the market started to move. So obviously it's gone up. You know, it's probably the rents nearly doubled, but the properties nearly quadrupled. So yeah, I don't see. I see rents continuing to rise. Unfortunately,
Tough times ahead.
yeah, for some cities.
I have to confess, I was expecting the mortgage cliff to have a bigger impact sooner.
I'll just wait. I think it's going to have a bigger impact on Sydney. That's where you're going to see the cliff. I think it's not going to have much impact on Perth. Queensland still going to be okay.
Yep.
You know, because their property prices are obviously lower. A lot of people, you know, if you got a mortgage of 200 grand, it's not going to, it goes from 2 to 7%. It's not really going to affect you. But if you went and loaded up on a, like I had my neighbour buy, a couple of years ago, 2.9 million in Castle Hill, and a lot of that's borrowed. 2 to 6 is going to be very, very painful. If you've got a $1.5 million loan or 1.6 or 2 million, you're going to be screwed. So I think it's more going to impact, and I think the next chart sort of shows that. So the one on the left, the capital city market. So this is the percentage of a medium income to service a new loan. I think it's at 80% LVR in Sydney. So they just take sort of the median dwelling value at 80% and how much, and it's
59%.
so 60%. And
that's insane.
Pre-GFC is probably sort of 47, 48%. So we're above that mark. I was looking at it, I think around 2018, 19, around here. Like oh, it's not too bad. Like it's still below, GFC, pre-GFC levels. But now, I think that's where the most pain is going to come. And a lot of those fixed rates are starting to come off now and towards the end of I think most of them will be off by the end of the year. And I think you'll see starting to bite a lot of people. Up there's Adelaide, so obviously prices are cheaper there, but it's taking a significant amount of their income. The income's a lot lower to service the mortgage. So when people tell you Adelaide's the place to invest, I think take that with a grain of salt. It's not far off its peak. And then you've got, I think it's Brisbane next. Look at Hobart. Hobart's in a bit of trouble. It's got like a more aging population, a lot of retirees down there as well. And then you've got sort of Melbourne, still, Sydney's probably nearly 50% higher in terms of the level there. Perth getting up there, but Perth, I think incomes are going to grow substantially in Perth. And then you've got sort of Darwin. Sorry, I always forget the ACT. So ACT is pretty safe. Government jobs, generally both partners work. They got pretty good benefits and bits and pieces. So pretty stable market, I think. Unless the 2 trillion in debt that Australia's in, and then the government needs to slash jobs, then that can mean trouble for the ACT. I don't know if you remember when Tony Abbott, maybe 10 or so years ago, he declared that he's going to slash some government jobs and cut the budget, and he didn't end up doing it, But the ACT market like dropped just on the back of that. People stopped spending.
Yep.
So worried about their jobs and whether they're going to lose their jobs, and it really shrunk the economy. But then you got Darwin. Incomes are actually pretty high in Darwin. It's got the cheapest median house price at the moment, and
That is pretty good.
if you remember that chart that I put up, 2000 to 2010, didn't have Darwin there, but it was the top performer. But obviously more risk if you got 5-6 properties and you want to take a punt. I think it's a good time.
Yep.
If it's your one and only investment, then you might want to stick to more sort of a blue chip. Stick to Perth, or we pick up something in Brisbane. But looking shaky, Tom.
The next couple of years, there was a KPMG report that came out in 2022, and it said that 50% of CEOs think that a recession's coming, and the vast majority of them were planning job cuts and layoffs. So, in the private sector, most certainly, it's happening, and I think the public sector will be safer.
If you read the book, generally that tells the secret life of real estate, mate. Generally that tells me it's not coming. It usually comes when no one sees it. So
yeah,
I think things will change for the next couple of years. It'll turn a bit more positive, and then when people are least expecting it, that's when the ass falls out of it.
I think the thing that everyone's underestimating is the impact of AI.
Yeah, I'm not underestimating it. I know people can adjust to that, but it's a massive, fast leap in technology. So
huge,
not like the previous revolutions. In that, I reckon, I don't know, bit of a conspiracy theorist, but I reckon a lot of the labor intensive jobs that are going to be replaced, like drive cars, truck driving, warehousing jobs, laboring jobs, even bricklayers have got machines that can lay bricks now, and I think they're going to struggle. I think there's going to be a lot of people out of work. They're just going to end up getting a bit of money from the government. You sit at home, you watch Netflix, can't go to the pub, you can't travel, you can't go out. You like the lockdowns, eh?
Well, the last couple of technology waves took out like a lot of factory workers, but I think like the next wave, it's going to take out quite a few of the white collar workers. Like if you look at the AI now, it's like it's replacing lawyers, it's replacing accountants, it's replacing marketers.
I think it's I don't know. It's hard to say, but people will adapt. The economies will adapt. Something will happen. But
that's true.
Unless they're going to have surveillance on us, lock us down, faulting because we all lost our jobs to AI. I don't know, maybe, but that's going to be a big shake up to the system. Like I think things will even out and level out, but I think it's going to be a disruptor.
There will be new jobs. Like in 2006, before the iPhone came out, there was an app developer. There wasn't user experience designer.
Always changes, but you need educated people to do their job. Like if you've
got it's a hard pivot.
Yeah, you got a truck driver, and all of a sudden the driverless trucks, like he's going to go work in a warehouse. They've just got robots now. Like you go, I think someone's telling me even in Australia, like Amazon, it's pretty much no one in the warehouse except for the bloke or the lady packing the boxes and sending them out. Everything else is done by robots. And I had a friend that went down to I think one of the book manufacturing distributors and massive warehouse as far as the eye can see. I think he said there was 4 or 6 workers, just office paperwork, bits and pieces.
Wow.
The rest was just machines running up and down, stuck in the shelves, picking the books.
It's amazing.
So, but we're still very low unemployment. So look, people I think there'll be adaptation, but I think there'll be less trained people will struggle, and I don't know. we'll see. I don't have all the answers to them. I could talk about property, but like it is important. That's what people need to realise. That's why a lot of the inner city areas, when the arse falls out of the market, a lot of low socioeconomic outskirts, a lot of the construction jobs, they lose their jobs, the market, even though the areas are cheaper, and you'd think that the property mortgage and that's more affordable.
Yep.
A lot of times they get into trouble.
Yeah.
Those type of jobs go first. And you saw during COVID, you had Qantas pilots stacking shelves in Woolies. There's always it's easier for someone educated, trained, to change. Look at me. I started off studied accounting, worked in accounting, then I went and worked for pharma companies in sales and marketing, then back into the banks, then into financial planning, then into real estate property. Changed so many careers, and totally different. It's not like accountant and went into accounting software or something like that. It's totally different industry. So we'll see.
We'll adapt.
So that was that. I might stop sharing. There's a couple other, if you want a couple of questions, or I think we covered the Melbourne. Advice for somebody looking to buy in the next 2 years: buy, don't wait a bit longer. I guess it depends if it's for investment or for you to live, and also where they're looking at buying. So if I was buying in Sydney, I'm probably looking for a house, and I'll probably wait 2 to 3 years before jumping in, let it sort of drop and sort of bottom out. If you're looking at buying in Perth, then obviously go for it. Most areas in Queensland, go for it. Areas outside of 20 k's of Brisbane, I'd be a bit wary. Places like Ipswich and Caboolture and some of the lower socioeconomic areas, I think they've got a lot more to run. But if you need to buy to live, then go for it.
On that note, do you think of a home as an investment? Like if you're buying for yourself to live?
Look, as an ex-financial planner, you're taught that your home's not an investment.
Yep.
But to me, it is. It is an investment. Like what you're doing, you can downsize, and there's that money to use later. It also allows you to fund investments, to leverage and buy other investment properties. So I think it is an investment. If you go spend money on it and fix it up, then you're generally adding value to that like an investment. So to me, yeah, I think it is an investment. I don't. Just depends how people want to look at it. But I think these days, with the size of mortgages and the commitment and what you're putting into it, then I think it's worthwhile looking at it as an investment that's going to grow in value, definitely. On the flip side, people need somewhere to live. So a lot of people don't like to keep moving, especially if you've got kids in school.
Yeah.
Rents go up. The landlord wants to sell. They up the rent too much. So there's always that aspect. Obviously rent. People say rent's dead money, but if you're renting somewhere, then you've got an investment somewhere else. So that sort of replaces that argument. So look, I'm not against people buying places to live in. A lot of property gurus that just invest, just rent. And, mate, people have a life. They want certain things. They've got children. They want to settle somewhere. They want to have something that's theirs that they can. Have to ring the landlord because I want to put a nail in the wall to hang it.
Yeah.
There's other reasons, but I think it is an investment because it's such a big chunk of your money these days. Whereas 40, 45, 50 years ago, a Ford Falcon GT was the price of a house. But I think any
long time ago.
Holden knew from the manufacturers the price of a house in Sydney. So it's just houses are just becoming so expensive that it's such a big chunk of your money and the amount of time it takes to save. And so I think it's an investment.
I never really thought it was investment because you're gonna need to live somewhere. So I always thought as a home is separate. And like
You
one
know,
of one of
you
the
can rent, like you don't have to buy it. So you can,
yeah
if you buy, you're riding the economic growth that's coming forward with it, rather than renting. You're not really getting a piece of that action, are you?
yeah. I always thought of like a home as just that. It's a home. Like I think about some of the improvements and stuff that we've made to the house. They're not financially like they don't make sense, but they make it more livable. The wife is happy, the kids are happier,
Yeah.
and for those reasons, it's not. I don't consider them financial decisions. Some of the improvements that we've made.
So you
But
were
having said
renting
that,
it, you'd have to fix up, that bathroom to keep it rented at a decent rental if it falls
yeah,
apart. Um, yeah, look, as a like I said, as a financial planner, traditionally, you're always told, oh, the house is,
it's not.
but like I said, a lot of people that buy other investments, they're always leveraging against their house. They're always, looking to use that. So to me, yeah, if it's an investment that's helping you invest and feed other investments, then
The one thing I do love about it is the fact that it's capital gains tax free. It's
that's a big
one
one.
of the few assets. It's massive, absolutely massive.
So ask me, I just sold my house in Auburn a
Did
couple of
you?
years ago and copped a big land tax bill. But yeah, it's it's not nice to just sit there and send away a quarter of the profits to the government that didn't do
Yes,
much,
yes.
and they sit there and change the rental laws on you and put the power back in the tenant, and you can't increase the rent, and you can't, it's just. I find that ridiculous. I find all manipulation in the market, even handouts to first home buyers and all that. All it does is just inflate the market, and all these
It does.
restrictions and everyone. There's a lot of people. They're saying, some investors are doing it, but they're selling up their investments in Melbourne. If there's no investors, there's going to be a smaller rental pool, which is going to drive up, rents and that. So it's pretty dumb when governments come in and look, if it's for safety and all that, yeah, no problem. But to restrict what you can charge in rent, like, we're supposed to be a capitalist free market system, but
Yeah.
oh, hang on, the banks are wobbling. Oh, let's get the taxpayer and bail them out. Oh, hang on, our rents are too high. Poor renter. Even though they haven't moved for 10 years now, like, they're doing the same thing in Brisbane. You can only lift the rent every 12 months. But say you lift the rent and then that tenant moves out after 6 months. For the next tenant, for the 6 months, you can't change the rent. So you
Yeah.
have to advertise it. Like, what type of communism is that? Like, like new rental, you go put it on realestate.com. If you're renting it for 500, you have to advertise. You can't advertise it for 520 or 550
Yep.
for 6 months. Like, that's just stupidity. Like, that's our capitalist free market. When it suits them. But
We'll
yeah,
probably find the rental jumps higher because it's a 12-month gap.
yeah. But then next time then they'll bring in restrictions. You can only lift at 5% per annum or 10% or whatever it
Price
is.
restrictions never work. Typically, what happens in markets when governments put in price restrictions is you start to develop black markets because prices find their way whether you like it or not.
Yeah, but it's getting harder with with the data sharing and whatnot. But yeah, yeah. You want to go through the rest, Tung? I think
Yeah.
there's one. We're looking for time. Rank preferred real estate market. I think we've done that. So Perth, if you want blue chip, Brisbane, 20k radius, not too far out. Perth, you can pretty much go wherever you want. I think you're going to have good growth there. Like I said, the one Darwin's and another one I think will start to go soon. I think North Queensland's got a lot of legs. So
Why? Why North Queensland?
I think just on the back of the mining sector again.
Oh, okay.
Yeah, so it's just they have their time. So with the mining, obviously 10-year boom, 10-year sort of not much, which is what we've been through.
Yep.
I think the next sort of 10 years is going to be good for mining.
Okay.
Um,
We're only 4 years into that.
sorry?
We're only 4 years into that 10-year boom.
Oh, not even, I think. Is it yeah, not even. I think we're going to run a little bit longer. So I think, yeah, probably a couple of years in. I think 2032 is my around there, the peak of the mining commodity prices and mining sector. I don't. That's just my tip, Tom.
Gotcha.
I'm going to read from smarter brains than me. I've covered the Melbourne thing. Are we going to cover the ASX traders question, or are we going to presume that was for?
I think that was for Jordan.
For Jordan. Is the land cycle thing? We've covered that. I think we've covered most of it.
Awesome.
What I think will happen with rates? I don't think interest rates are coming down anytime soon. I've been saying that for a long time. I said they were going to go up when everyone's saying.
Yeah.
I even had some quality financial planners that I work with say, "Oh no, rates aren't going to rise." Till 2025 or 24, 25. But
inflation's gone up, and the bond market has gone up in terms of yields. So both things point that rates are going to go higher.
Had a lot of clients that ring me now. So thank God I listened to you and locked in at 2% or 1.9 or whatnot.
Yeah.
Even though RBA was telling them different stories. So even when I was saying it was going to come down over the last 2-3 months, I know it's probably that's including the 18% years and whatnot, but longer term averages are, I think, around a 7.15 for interest rates. If we exclude that, I think they're going to get to 18% and whatnot. But I think we're, around, the more recent, probably future longer term average, 6.5 type percent at the. I don't see them coming down. I think if economic prosperity picks up the next couple of years, I think you're not going to see them come down. If people are expecting that, I hope you're not banking on it. But,
I think that's just wishful thinking.
I think it is. We covered, I think most of what we.
I think we've answered all the questions.
What we had. But, Any other questions, Tom, you thought?
The key takeouts for me was, because I'm in Sydney, if I've got capital to deploy, wait a couple more years. Now's not the great time in that winner's curse period to keep doubling down, unless I wanted to look at Queensland or Perth, other markets that still have some trajectory.
Yep, I think.
And the other thing that you shared was, given how houses have gone gangbusters and apartments haven't caught up yet, the apartments will have to catch up simply because there's not enough supply of housing.
Did you end up getting that Parramatta one?
I did.
There you go.
I did.
That'll do all right.
It was $100,000 cheaper than it was 12 months ago earlier, because they just couldn't find a buyer.
Right.
And so it was off the plan. It hadn't been tenanted and had been empty for 18 months.
Yeah.
And so we just put a lowball bid and we got it for $100,000 cheaper.
You'll see that.
More of that happening.
Yeah, it's probably already started to.
And to be honest, I was really surprised by the rental yield. So, we were getting probably 6% off that property.
It's really good. That shows you it's below market price. You're getting.
Yeah, which I thought was quite good considering.
For apartment in Sydney, you're probably expecting sort of that, 4.5 maybe.
Yeah.
Brisbane maybe about 5, Perth probably 6.5. But and the rental, apartments, they need to have a little bit of a better rental just for the strata costs and.
They do. That's true. Yes.
So that takes a bit of the shine off and sort of brings it a little bit lower down. But with strata, you got your insurance covered in there, so you don't have to insure it. You obviously pay just landlord, which you would pay on a house. But there's 15 to $2,000 that you probably have to insure a house for similar construction costs to that apartment that's covered in the strata.
Yep.
If the wall cracks, they fix it. You don't have to fix it yourself or claim it on insurance. So there's a lot of little bits and pieces that you would pay on a house that you wouldn't. But even that aside, strata still,
What I love about that strategy was this comes down to thinking very far ahead. So, eventually when the kids grow up, we're going to downsize. We're not going to live in this 4-bedroom house forever because I don't like mowing the lawn. I don't want to clean like a massive house. And so I found this massive loophole in superannuation. It's called a downsizer contribution. So you could sell your home, not pay any capital gains tax, throw $600,000, which is a massive lump sum, into your super,
Yep.
which means you're not paying any tax on that income, like further down the track. And then Sylvia and I were just going to plan to move into the Parramatta apartment when we downsize. So it's almost like you're buying into something that you plan to live into the future.
Yep.
You've got your principal place of residence, you offload the principal place of residence, you move that money to a tax haven, and then you let the tenant and the tax man pay off like most of that property, and then you just move in when you're ready.
Eventually.
That's the plan.
That's a good plan. That's
It's not a bad plan. You just have to be able to think like 5-10 years ahead.
yeah, you have to. You have to. But sometimes even like when I bought my unit in Brisbane, like on the water, and even though I was ex-financial planner, and then another financial planner that I knew was just chatting, and I was talking about structure and whatnot, and he goes, "Why don't you put it in your super fund?" I'm like, yeah. Do you know what? I didn't think about that. He goes, "What's the plan?" I go, "It's for my kid. Like, I want to buy each kid a property." He goes, "Yeah, but
Yeah.
when are you going to give him the money?" I said, "Oh, probably another." Back then, probably not like 20 years or 25 years or whatever.
Yeah.
And he goes, "Well, you just buy it in your super. That way, when you sell it, there's no capital gains tax.
Yes.
Just offload it, give him the money, and he can go buy what he wants, like to live in."
But the problem with that, Omar, is you're my age, so you're not 50 yet. You can't touch your super until you're 60. By the
Yeah,
time you're 60, your kid's 30 something, right?
no, my kid's only 13 now, so
Oh, okay. You got young
he's
kids.
younger than yours, mate. I
Okay,
left
you
my
got young
dad
kids.
late. I didn't hang up.
Okay.
I didn't hang up the dancing diesels till a bit later than you. I got married at 32. Had the first one at 35.
That does make sense then. Yeah, to
You were
buy it in
already
super.
already in high school. You were once before.
Yeah, we started way young.
No, you do. So yeah, like it. Yeah, it just made sense. If I can even retire for a short time, get rid of it.
13. Okay, so
Yeah.
23 by the time you're 60.
23. Yeah. I'm a bit
Okay.
younger than you. I'm only 48. So
48. Okay,
I'll be
1 year younger.
49 this year and late this year. But so yeah, but I didn't even think of it myself. Structuring again for property.
I seeing more people buy properties within their super.
When I first started this business in 2012, probably 75-80% of my clients were super funds. As the bank started to get out and rates started to sort of rise above sort of other investments, and just the compliance costs and bits and pieces, it started to die out, especially after the majors pulled out of the lending market. So it was small second tier, and they charge a lot more interest. So now, not very few, but probably maybe 10-20% of super funds.
Wow, that's a big shift.
Before, yeah, the majority. I've noticed it's making a bit of comeback the last sort of 2-3 years. But people, and also the price of the property, Tom, is a lot of people don't have, like, when you had 250, 300 grand in super 10 years ago, that's sort of, that's a 50% deposit on a house in a good area in Sydney. 300,000.
Whereas now it's not even a 20% deposit.
You can't do it. Like, you can't actually get the loan. And I think, just the costs and compliance and it's made it a lot harder for people. The rules, and I find a lot of people come to me, so I'll set up a super fund and my accountant did this, and I'm like, your accountant should be shot. Like, you don't have enough money in there. What are you going to buy? Like,
I haven't done it myself.
Well, ASIC recommend $500,000 like before you set up SMSF. So that's there used to be 300,000, and actually I didn't check. That was from a year or two ago. So like it's you need a decent amount of money in there, because you got to put, because the rates are so high. You need to put before you put in a 20%, 30% deposit, maybe lower rates, sort of 3-4%, close to cash flow neutral. But now, like super funds, you're looking at 7.5%, 8% interest.
Yep.
You need a big deposit. Otherwise, it's going to be sucking up your contributions just to pay the interest. Where you want your contributions to be paying down the property, not just paying the holding costs on it.
Yep.
But for some people, yeah, it's a good strategy. You miss out on the tax benefits now, except for your contributions and whatnot, but you get massive tax benefits down the track.
Yeah.
No capital gains tax.
Yeah.
It's under the thresholds. Once you retire, the rent tax free. So the
rent's tax free once you're 60.
So there's a lot of benefits, but the benefits come later. So if you bought that unit that you bought, fairly new, like significant depreciation,
Depreciation.
Structure and that, yeah. But you're only getting 15% for the depreciation, whereas if you're a high income earner with the Medicare levy and that, you're getting 50% back. So
yeah,
a lot more tax effective, tax minimizing in your own name.
Yeah.
Where you're minimizing the tax is where you're putting the contributions, extra contributions, and paying 15% tax instead of 50, like on 48 or whatever it is on your income. So but you need to be careful. So where I got done, we'll talk about the capital gains. So how you could go back in time and top up your contributions up until the concessional.
Yes.
Because I sold the property and then I knew I was going to sell it, so I didn't pay myself any income for the whole year.
Yep.
To have zero.
Gotcha. Yep.
And then obviously that came in, bumped up my income, top marginal tax bracket. So
yes.
Smart. I put a bit extra 70 grand or something into super. Sort of caught up some contributions, put it in.
Yeah.
And I said, oh, hang on, because you're above X income, we're going to tax you 30% on the contributions, not 15%.
Oh.
So I lost half the tax benefit. Still worth it, but you go this way and put a roadblock, or a detour at least for you. But but still more than worthwhile.
In your travels, have you seen anything else as good as the downsizer contribution? Because when I came across that, I just thought that's absolutely amazing. Why have not heard about that before?
Yeah, no. Look, the non-concessional contribution is good too. Like if you got money you want to shift into so what people need to think about. We'll get into a bit of the financial planning. So this is general advice. Not. So with property, you don't have to have any disclaimers. Like you can say what you want. There's no real restrictions. But so what people need to think about is people think of super as an investment. Super is not an investment. Super is a tax.
It's tax regime.
Yeah, structure for you, and there's massive tax benefits by using it. So the more money you can. I know now they're putting caps and whatnot and extra taxes and up certain levels, but it's been a long time, so it's not really my forte anymore. But putting money in super is a great idea. Even if you got spare money, just getting it up to the 25. I think it's going up to about 30. So getting it up to that, if you can spare the money, it's like if I give you, so say you're 45% tax bracket, if you put money in super, you're saving 30% tax. So I'm giving you a 30% return on an investment for zero risk. Like
zero risk. Yeah, it's free.
Like it's just money for jam. So if you can do that, like you'd be stupid not to. So there's only 3 ways for someone to save tax, and if you pay as you go, remove structuring. So like using trusts and companies if you're working for someone, and it's property, negative gearing, or even negative gearing if you're borrowing to invest in shares, and super. Like that's the only two options, unless you're, like I said, you're self-employed. You can do some structuring. There's very little ways to save. So like if I'm giving you a 30% return for people watching, that's your 45% marginal tax bracket. Forget the Medicare levy, and you put into super, you're paying 15% tax instead of 45. So you're getting 30% on your money. So if you're contributing, 10 grand, you're getting 3 grand in the tax saving. Yes, it does go into your super fund and it's locked away, but who cares? So you're getting a 30% return on your money. There's no investment that gives you a 30% guaranteed return with zero risk. So that's
the closer I get to 60, the more I appreciate that.
Yeah, but that's the thing. The problem is, the sooner you get started, the better, with the power of compounding. And I think I don't know if you've spoken about this in the past, Tom, but if you get someone that's 20 years old, puts in 10 grand a year into super till they're 30 and then stops, and then the other person waits till they're 30, can put 10 grand into eternity, will never catch the person that started, did the 10 years and then stopped, just because the power of compounding. So, but that's the problem with super. Like, the sooner you start, the better. But you really don't get in a position or even start to think about it until you're, getting to our age where, we're
Yeah.
getting close to God's
The
waiting.
vast majority of people don't start thinking about super until they're 50 or, yeah,
And now it's
until they're
like
about 50.
chasing your tail. Like, you could have done so much more previously. So for people, it's worthwhile looking into it. The younger you are, the better. The sooner you start, the better off you'll be. So go get a spreadsheet. Year 20, 21, 22, 10,000. Pick whatever interest you want, compound it, and then start the other one at age 30. And
That's a good tip, especially now that they changed the laws with super, so you can withdraw to buy your first property. That's
I don't
amazing.
know how many people are doing that, to be honest. Like, and there's a lot of compliance and paperwork and bits and pieces. But like I said, I'm not a big fan of that stuff. Yeah, I'm not a big fan of super. Leave it, sit on it, invest it for the future. It's there for your retirement, and also save the taxpayer money funding your pension and that. Because our kids are going to be broke trying to fund our retirements, but not you. Talking, you could live off the smell of an oily rag. So
I live cheaply.
You'll be cheap for the taxpayer, but
I live very cheaply.
there's some other people that'll be, severe drain on the taxpayer. There's going to be less and less workers working to fund retirees. So
Yeah, that's true.
I'm not a major fan. The other thing I think the government should do is like stamp duty. So, like, say for yourself, you're downsizing from a $3 million house to a $1 million apartment. You shouldn't pay any stamp duty, for that property. If you're going from a million to a 3 million, then maybe charge them stamp duty on the 2 million. Like,
yeah,
so they still need money in their coffers, even though they don't spend it wisely. But I think for that'll get people out of houses and into smaller accommodation, and because you're an old person and they're usually asset rich, cash poor. So if you're going to go buy another property, you're paying a massive amount, especially in Sydney with the price of property. It's a massive deterrent for people to move. So if you want to increase the supply of housing for young families and get people out of these big houses that they don't need, then just get rid of stamp duty for them. And they're actually doing it in, I was reading in, I think Tassie, I think. Is it Tassie? Only for a couple of years, but they're looking at, no stamp duty for first home buyers, I think up to about 7.
That's a great idea.
But they're also doing it for downsizers as well.
Okay.
That's like, this should be permanent. Stamp duty should have been gone when the GST came. But
I don't mind paying stamp duty for my second investment property, my third investment property, but for your first home, that should be a given.
Should be no stamp duty. Or like I said, if you especially if to create a bit more supply, just get rid of it. Like if you're upgrading, you're buying a mansion and you can afford it, and okay. But if you're downsizing, then you've already technically for that like for like you've already paid. But if you're moving up, then no problem. But
you make a really good point about people being asset rich and cash poor. Like I look at my dad. He's still living in the 6-bedroom house that I grew up in on Hap Street. My wife's parents still live in their 4-bedroom brick house in Regent's Park. It's like they don't need to be living in like those large monstrosities.
They're usually on their own, or sometimes they're single. One like my mum, she's by herself in it's only a 3-bedroom house, but like they just don't need the space. But it's so expensive. Like you're going to go buy you know, I want to go buy a unit, $1 million. That's 50 grand stamp duty. Like, where's my mum going to come up with 50 grand stamp duty?
Yeah.
Like, and you know, you got to sell the house. You think, okay, but I've got to have something to, you know, there's timing issues and bits and pieces. Like, you know, okay, I'll sell the house and that'll fund the stamp duty, but they need somewhere to live. So, yeah, they should have got rid of stamp duty ages ago. But just to create, you got to create momentum in the market. Like, you know, get it moving. So imagine there was no real estate agents commission; they just work for free. Everyone will be turning over property a lot more. You know, like it's the same concept that you take out the costs, and like people with stocks, $20-$30 to sell them, you know, easily traded. Like, if they come in and every time you got to pay, you know, $1,000 brokerage, and you'll be thinking long and hard about, you know, selling, and you know, you'll probably hold a stock that's dropping like a knife because you don't want to pay the $1,000 to get rid of it. So, yeah, it's just a impediment to the market.
Awesome. Great chatting with you, man. Thanks for making the time tonight.
Likewise, should do it more often. You've got to get a motorbike.
We should.
You can go riding or
I'm